This program provides education, not advice. Sponsors pay a fee for endorsements and interviews. See the truthayf.com disclosure page for details.
This is where technology, innovation, and personal finance come together.
This is the truth about your future with Rick Edelman. Brought to you by Global X ETFs, dedicated to providing investors with unexplored intelligent solutions. And by Invesco QQQ. Anyone can become an agent of innovation with Invesco QQQ. Invesco Distributors, Inc. And by Presidio, offering a digital vault where you can collect, protect, and share all your important people, places, things, and documents with all the key people in your life. Start for free at Presidio.com.
It's Friday, August 11th. On today's show, how to choose the right financial advisor for you. 48% of retirees say they have experienced more surprises and challenges than they expected, and that they have significantly disrupted their retirement well-being. What are these surprises and challenges? Most commonly, having a family member or close friend die. 42% say they've had this happen to them. 77% of them say it was an extremely disruptive event. Also, personal health issues. 30% have experienced this, half saying it was extremely disruptive. A spouse or partner having health issues. 21% incurred this. 42% say it was extremely disruptive, and 56% of women say they've had to adjust their lifestyle in retirement because of their spouse or partner's health issues. 20% have also experienced a significant financial setback. Inflation, the cost of living, medical dental expenses, unexpected home repairs, decline in the value of investments, the need to provide financial assistance of family members or friends. 75% of retirees say they've had to reduce their own everyday spending. And finally, unexpected retirement. 30% of retirees say they retired sooner than they anticipated. They suffered unexpected health issues, or they got laid off at work in a downsizing, or they've had to incur family responsibilities such as caregiving for someone else. All of that translating into them retiring sooner, and that has had a big impact not only on their lifestyle, but their finances. In fact, the number of people who had to take hardship withdrawals from their 401k rose 33% over the past year. The average withdrawal over $5,100. So as you prepare for retirement, you need to accelerate those plans. I'm not saying you should retire sooner. I'm saying you need to assume that you might have to, and that it might be because of reasons that give you a significant disruptive event. Talk about it with a financial advisor. If you are a financial advisor, talk about this with your clients who are facing retirement. Do they recognize the risks associated with having family members pass away, incurring medical issues themselves or their spouses, financial setbacks, or unexpected retirement because of job loss or family issues? Now's the time to prepare before you experience any of this. Coming up next, a conversation with Matt Barthel, the guy behind the rankings of the top advisors in the nation from Barron's.
Where do you store your important documents? How do you keep track of what you have or where it is? Use Presidio, the digital vault where you can collect, protect, and share all your important people, places, things, and documents with all the key people in your life. What you have and where you have it. You'll always know where your valuable information is kept, and you can easily and securely share your info anytime with anyone you choose. Try Presidio free today at Presidio.com. That's Prisidio.com. Presidio.
you're listening to The Truth About Your Future, well, if you've been listening to my radio show and podcast for the past several decades, you know that I've been several times ranked the #1 independent advisor in America by Barron's. And you know that the firm that I founded, Edelman Financial, was ranked the #1 firm in the nation multiple times by Barron's, and is still ranked the #1 firm in the nation by Barron's. How does that happen? Where does that come from? Well, this is the guy. Let me introduce you to Matt Barthel. He's the executive editor of Dow Jones Wealth and Asset Management Group. Matt is the guy who is responsible for running the rankings at Barron's. Matt, it's great to see you, my friend. How are you?
Rick, very good to see you too. And, congratulations on all your past success. And it's not just me. There's plenty of other people working on it, but love to be the face of it. They could get someone more handsome.
I'll accept you. Matt's been a financial journalist for 30 years, went to Notre Dame, although, Matt, you love to say you have absolutely no sense of humor when it comes to Notre Dame football. So we won't talk about Notre Dame football. But let's talk about the rankings, because this came out of nowhere, and it was an incredibly necessary and important need. You have filled a huge hole, a gap that existed in the advisory field, not just for the advisors who participate in the rankings, but more importantly for the investors who seek out these rankings. Because we're dealing with investment advisors who collectively, there's 300,000 of us in the industry, and we're collectively managing, I don't know how many tens of trillions of dollars that all of these advisors and all of these firms are managing. And we're managing all of these trillions of dollars on behalf of ordinary Americans, everyday families, as well as high net worth individuals who are seeking to secure their financial future. And in the old days, if we go back long before you and I were born, the whole shtick to investing was picking the right stocks, picking the right investments. Today, it's all about picking the right investment advisor, because the world has gotten so complicated. Most of us don't have the knowledge, the skills, the time, or the desire to do it on our own. So we're delegating, we're hiring people to do it for us. But how do you know who to turn to? Who do you trust? How do you know what the services they provide and the credentials that they offer and the fees that they charge and all that kind of good stuff? And there was no way to answer that question. Along came Barron's. And you have now championed this notion of ranking the very best advisors in the industry. And I think for most folks, it's a little bit of a black box. They don't know how you go about doing it. And that's why I'm excited to hear today to pull back the curtain. You know more about advisors than anybody in the industry. You collect data on thousands of advisors. Talk about how you go through the process of identifying the nation's best financial advisors.
Well, all right. Well, that's my job. The one thing I'll put on it up front is the thing that's increasingly difficult to do is to separate individual advisors from the teams or organizations that they work on. When I started doing this, I'm 15 years into doing this for Barron's now, working on the rankings. And when we started doing it, very well, you yourself were the head of a big organization that wasn't quite as gigantic as it is right now. And you were an advisor who set investment policy for a whole bunch of people. And, you had ultimate responsibility for how things went on that, right? It was pretty easy to separate individual advisors from the organizations they worked with, or at least say how much of what's going on is attributable to that advisor, turn it into a metric and rank them. That's getting harder and harder and harder because the organizations are, the teams that they're working on and the firms that they're working on are getting bigger, more horizontal, and having a whole bunch of more capabilities. That's all very good news for people who are looking for financial advice. It complicates our job a little bit because we're trying to figure out how to move from just ranking individual advisors to, which people in America love. They love to hear the name of the person, right? To ranking the organizations as well and pointing people at organizations, which are going to be more enduring, right? Than just a person who might retire or whatever. But back to your main question, how do we do it? We measure a whole bunch of metrics. First thing is there's no subjective element. Matt thinks Rick is very, very good for his purposes, or evaluates him and says, Rick ought to be really highly ranked in these rankings, or get some points because I've done some evaluation on that front. Our stuff is metrics based. Our rankings are metrics based. We look at the assets that the advisors manage, the revenue that they gather, which I'll get to. A lot of people ask, why do you care how much revenue an advisor gathers? And there's a reason for that. And then there's 15 or 16 quality measures that are, their ability to service clients, essentially. Put into a big, calculator, basically. And after we get all the metrics scrubbed and measured out, it creates a ranking. Assets, I'll do a real quick thing. Assets are a good measure. The growth of assets are a good measure of the health of a practice, and whether an advisor is somebody who's constantly self-evaluating, not complacent, moving forward. It's kind of, I always say it's like the bubbler in a fish tank. You got one of them, you're okay. You don't have one of them, the water gets very murky and still and dead pretty quick. Revenue, the reason we care about revenue is it is the fees that clients pay to advisors is the best proxy for client satisfaction that we know of. We're in a world of Amazon, rating 4 stars, 5 stars, giving an Uber driver a rating of something after you used it. That's useful, but we've all read an Amazon review where someone says the packaging was broken, 1 star, and that says nothing about the product itself, right? So you really know what people are doing when they are saying, yes, I see value for the whatever amount I'm paying this advisor, and I'm sticking with this advisor. So the retention rates and the amount that they're paying are really, really good proxies for us of client satisfaction. And then these quality of practice measures that we have are, how long have you been in the industry? What does your regulatory record look like? How many people do you have on your team? How old are they? Are they staggered out, or is it just a whole bunch of 62-year-old people who are going to retire all at the same time, leaving their clients in a lurch, right? How many households do you have? How many assets? We triangulate between that and the people on the staff to arrive at your ability to service clients. I could go on and on. There's a bunch of charitable and philanthropic work. And again, so all of those things, I won't kill you with any more detail than that, but those are the 3 basic categories: assets, the revenue and fees that they gather, and then the quality of their practice.
And you mentioned that it's increasingly challenging because many successful advisors, most of the successful ones, I would argue, are growing in size to the point where they're not sole practitioners anymore. They're part of big teams. They're building big teams, leading big teams. And so you're finding it a bit of a challenge there. And I think this is reflective in the fact that your rankings have changed. In the old days, you had one list. There was the list of the top advisors. Now you have multiple lists. You have a list of top advisors. You have a list of top independent advisors. You have a list of top teams, top firms. You have top women. So talk about the growth of the lists and how they are reflecting the changing nature of the advisory field.
Okay, so one of the most important things about the different types of lists is that there are different types of advisors. There are RIAs. There are independent broker-dealers, and there are advisors who work at the big brokerage firms like Morgan Stanley and Merrill Lynch. I know you've talked about this on the show before, but the regulatory structure around the wealth management industry is a mess. Anybody who would find any of the people that I know who I associate with, friends and stuff, where I tell them that a lot of those people who are advisors out there are not held to a fiduciary standard to do work in the best interest of their clients, are flabbergasted that is the case. And it is pretty ridiculous when you really get down to it, that there's this patchwork of different standards that different kinds of wealth managers are held to on how they have to deal with their clients. So we do have different rankings, some for independents, RIAs who are held to a fiduciary standard, who have to act in the best interest in their clients. And then we have rankings that are aimed at advisors who work for brokerage organizations who are held only to a suitability standard, meaning they have to put advisors in or clients in investments that are suitable to their needs and their risk appetite, but they don't necessarily have to find, for instance, the cheapest investing option that is risk appropriate. They could do something that's good for them. Again, a lot of people, who don't know a lot or who haven't taken a lot of time to dive into the industry are flabbergasted that that's the case, but it is. That does not mean that anybody who works at Morgan Stanley or Merrill Lynch or UBS is a bad advisor. Many of them, probably most of the ones that we deal with, are dealing as fiduciaries or working as fiduciaries because it would be terrible business for them not to. They'd lose clients pretty quickly if they weren't doing a good job of it. But the fact exists that the patchwork, the regulatory patchwork, is not serving clients very well. It's not serving end investors very well, and it's particularly not serving people who don't spend all their time looking at the industry trying to figure it out very well. Okay, so we have different lists. We have 8 different lists now. So individual advisors, we rank them, we break them out by state geographically. That's the biggest and broadest one that we do. You mentioned that there's 300,000 advisors in this country. For our purposes, we look at that more like 120 to 150,000 of advisors who do this for a vocation, who are really truly doing advisory work, not CPAs who kind of have the licensure and so forth that they need to call themselves an advisor. Nothing wrong with that. I'm just saying they're not full-blown advisors the way some of the others are. That geographic ranking is a top 1,200 ranking. We consider it roughly a top 1% ranking. And then we do a bunch of top 100 rankings, top 100 women in the United States, top 100 independent advisors, those are the fiduciaries, top 100, just the top 100, the one we've been doing since 2004, but that has evolved into mostly a wirehouse ranking, advisors who work at these big firms like Morgan Stanley and Merrill Lynch. And then we do a ranking in Australia, which we were just talking about, I'm working on right now. And we have a couple of teams rankings and organizational rankings that are coming in. And those increasingly are the main event for us. Private wealth teams, people who deal with teams that deal with families and individuals, institutional consulting teams, those who deal with institutions, pension funds and endowments and foundations. And then we rank RIA firms, so independent firms, which are the fastest growing segment of the population, into which Edelman Financial Engines, that's the category they're in for those purposes. So that's a lot, and you can tell that things have gotten more complicated. That's basically what that's reflecting, and we're trying to figure out the best way to kind of point people who are looking for guidance and looking for good advisors at places they can find them. And increasingly, these organizational rankings are the place we're going: private wealth teams, institutional teams, and RIA firms.
And within this huge array of advisors, 120,000 in the universe that you're looking at, boiling it down to the top 1% for the state lists that you have of 1,200 advisors, and then the smaller lists of the top 100, that's the cream of the cream. And when you look at all of this, I mean, I know the answer to this, but I want you to say it for the sake of the audience. There is an incredible diversity in the array of services and the types of clients each of these advisors choose to work for. Talk about what you discover in this incredible array of variety in the industry.
So there's been a big change in the last 4 or 5 years of, it used to be almost every advisor would talk to you about, you'd sit down with them, they talk to you about your investments. How are they doing? They'd give you a flip chart or a PowerPoint presentation that said, this is your risk appetite, this is what we put you in, these are your returns, these are your fees, this is how it's going. Increasingly, you're going to have to do a good job of that as an advisor. That's why people go to you. You have to do a good job with the investments. But increasingly, clients are expecting that you're going to do a good job of that, and they're like, show me that in 5 minutes that it's going well, not 45 minutes of stuff I don't understand about how I'm in alternative investments that whose fee structure I can't even possibly comprehend. Show me that things are going well. Show me what my fee schedule is and how and why that's there. And then now it's sort of, what else can we do for you? And advisors are really differentiating themselves if they're smart. The best of them have a really, really good idea of what their value proposition is. So, for instance, many of the best teams are hiring estate attorneys on their teams, where they used to kind of have partnerships outside. Many of the best advisors are hiring them and saying, if you come to us, we can handle everything you need to do, from wills to taxes to, how you're going to hand down money to people in your family. And, we can do that soup to nuts, and it will be somebody who really knows you, who knows chapter and verse about everything that you're doing. And those conversations get very, very deep very quickly when you have that. The teams are, as I said, are establishing these value propositions around what they're really, really good at and what can separate them from other people. So if you're looking for an advisor, or if you're interviewing an advisor to consider using them and becoming a client, one of the first things you'd want to ask, I would think, and I just did this myself, by the way, is what services do you offer? What are the range of services that you're offering? And, what are you really, really good at? What am I paying for? And am I using all of the things that you're putting on the plate for me? One of the things I found myself, this is what I do for a living all day long, is talk to advisors. And a couple of years back, I had an advisor who was very good. I like her very much. 10-year relationship, 11-year relationship. And I got to a point where I'm like, hey, listen, I'm paying almost 1% of my assets to you. I don't use most of what's there. Really, what's happening is you're doing my investing, and I don't use anything else. What are the other things that I should be using from you? There wasn't a really great answer for that. And I've retreated, and I'm saving myself $10,000 a year in fees by using somebody. I use everything that the person I'm working with now is doing for me. I use it to its fullest extent. And if I step over that, she charges me, and that's perfectly fine with me. So this thing of, there's a really wide range of services and value propositions, which sounds business schooly and jargony, but it's a legit thing, right? Where there's an advisor that we work with. I'm going on a little side tangent here on a value proposition, but she is a really, really good independent advisor. She dropped out of the industry, got a law degree, and then attended the Ron Perlman, Ellen Barkin divorce proceedings. So a billionaire and an actress divorcing, and learned everything there was to learn about these, what it is to be a woman going through one of these divorces, and what the finances look like on the tail end of this thing. That's her value proposition now. It's like 80% of her practice now, right? So when looking for an advisor, that's probably the best thing you can ask is, what do you do really well? What are you charging me for? And are these things aligned with the things that I need? And as you're looking at my stuff, what is something maybe I'm not thinking about that I ought to be thinking about? Maybe you can help me out with that. But as you mentioned, a lot of different flavors now developing. The investing portion of it is table stakes, and now the range of services are getting very, very, very broad. It can be anything from trying to find a yacht for you, down to, if you're a person like me who can't afford a yacht, just down to how much are they helping you with, the saving for college, but maybe they know somebody who's really good at getting your kid into college, right? There are people who follow those sorts of value added kind of things. So that's part of the interview process. I think if you're looking at an advisor, is what services are they offering?
I think you've really made it a whole lot simpler for everybody, because this subject is so intimidating, Matt, as you know, to most Americans. We are not educated or skilled or trained in the subject of personal finance, and we're intimidated by the subject of money because we don't have a lot of knowledge and experience with it. And you've made it really simple by helping people realize you don't have to become an expert about money. All you need to be is an expert about you. You know what your needs are. You know what your concerns are. And if all you can do is articulate your fears, your aspirations, your goals, your objectives to a prospective advisor to say, here's what is worrying me. Tell me how you would be able to help me. And what am I not mentioning that I ought to be mentioning? What is it I haven't even thought of that you can say to me, oh, have you thought about X? That's how I'll be able to determine whether there's value in us having a relationship together. And I think you're exactly right. Because there are so many different types of clients who are dealing with types of issues, and there's so many types of specialties in the field of personal finance. No advisor can be an expert in everything. And this will help you find the advisor that's right for you. And I would imagine that you would say, you haven't, so I'm going to put words in your mouth, Matt, that you would shop around when you're seeking an advisor.
Rick, I was just going to say that very thing. If you were building a patio out back, you'd get 3 estimates, right? You talk to 3 guys, you'd have 3 people come back there and tell you what it is, and you'd find out one of them's a charlatan, right? Or whatever, right? Or this person is $4,000 over the other two. Why? And you can ask that. Why are you over $4,000? And they may say, he may say, she may say, we're better. And here's the reasons we're better. And maybe that's worth it to you, right? And there is no accounting, honestly, for what you're going to want from an advisor. We have my old coworker Sterling Shea, who now works at Morgan Stanley, but we were, I like to say, our married couple at work for many years here at Barron's. When we were doing a research in the UK, he met with somebody at one of the custodial firms who was lamenting that his father was a client of a firm I won't mention, who was paying 4% which is a lot, of his assets, a 4% fee to his firm, wealth management firm that has existed since the 1600s in England. And he's like, Dad, you cannot do this. It's way too much money. I, for starters, look like a fool having a father who's paying this much money. And he says, I go in there 3 days a week. They have a room for me. They have my tea the way I want it. They show me how it's doing every day. Sometimes I go in twice a day. I am a high, touch, high value guy. I am fine with it. They are outpacing that. I'm still growing at that. I'm okay with that. So look, no one's going to pay 4%, but it's like, there isn't any accounting for what that value is up to you. And you have to decide what kind of value that advisor is bringing to you. But it starts with asking what they're going to do for you. And while I'm mentioning England, UK, they have something that I wish we had here, which is they have a one-page fee disclosure that every client gets. And it says at the bottom, how much did you pay? How much do you have with them? How much did you pay? There's no pages after pages of this, and then there's a fee attached to this, and then we build it into that, and we take it out of there. I mean, even I can't quite figure that out, right? And again, I do this for a living, and I hope that a developed country like that influences us as this works its way through the regulatory stuff, and maybe it comes back to this fiduciary standard just being broadened and maybe simplified for people. I think that would be a great starting point for helping people choose advisors, is how much am I paying and what am I paying for, right?
And some, as you noted, people are often willing to overpay if they are getting perceived value for it. And a big element of this is the fact that this is not a commodity. This is very much a very deep, intimate, personal relationship. You have to have a connection with this individual. That's a big part of it. Talk about how you evaluate that.
Well, I say sometimes where, my father and my mother, there are people who compare financial advisors to doctors in ways. There are massive differences, but there's a lot of professional commitment, all that stuff, and it's super important to you if you're going to a doctor. My father was a guy who was like, I'm a slab of meat. Do not talk to me. Do not be distracted. I don't need you to hold my hand. I don't even want to know anything about. I want to know that you're a good surgeon and do not be distracted. Do a good job. My mother is like, you can leave a scissor inside of me after you get done cutting me open if you talk to me well, if you're a good talker. It's all over it's all over the map in terms of what people would be looking for from their advisors and what they want from them. So that is a super important part of establishing who you're talking to and how the character. Increasingly with these teams, if you have an advisor who has a personality, how does that personality, if he's got 22 people, or if someone is heading up a team and has 22 people working on that team, how does the personality of that person you're dealing with find its way into the team? How does that create a culture that's going to endure past when that person who's 59 years old is going to retire, and you're still going to be with the firm? But how does that get into the rankings? It gets into the rankings. This is the nice thing about it, is I don't have to evaluate how good a job Rick does at connecting with his clients. Rick is going to do a job of connecting with his clients and finding who his people are. And if he doesn't have a good value proposition, good culture, good personality, his practice probably isn't going to grow at the same pace as somebody who has done a good job of the value of establishing that. So the good news is I don't have to do that, and it wouldn't be good if I were doing that, because I might be the guy who is okay with the 4% and someone else wouldn't, right? So it takes care of itself is in the rankings is the short answer to that question.
Let's talk about that 4%, because that is, of course, an anecdotal, funny number. You're making a point. I've never heard of any advisor in the U.S. charging such a high fee. But let's talk about fees, because that is a pretty important element of the relationship and the experience. In the old days, it was commission-based business. You bought stocks and you paid commissions for trading. Every time you bought, every time you sold, the broker made a commission. That has given way largely. It still exists in the marketplace, but for the most part, commissions have fallen by the wayside because consumers were always concerned about the conflict of interest. Is this person telling me to buy and sell because he was trying to generate a commission, or because it's really in my best interest? When you have a fee, the fee is detached from the transaction, so that there isn't that obvious conflict of interest. So talk about what the range of fees that you see and what you feel are appropriate, that should raise a red flag or what have you. Talk about fees broadly, Matt.
So fees are getting complicated because, if you're an investment only client and that's all somebody is managing for you, that fee should be pretty low, unless they're doing really bespoke, specific stuff for you. You want to invest in Russian timber trusts or something, and this is the expert who does it. God bless. That could probably cost you some money, right? The first thing to start with is, what are the range of services that you're availing yourself of with the advisor? The standard has always been, as most people know, 1% of the assets that an advisor is managing for you, that will be the fee. And if you're just doing the basic math in your head, if an advisor is, getting you 5, 6, 7, 8% on average over years, over what you're on your investments, you lop a 1% off of that, and that feels okay, right? The trick is, if you have $100,000 with an advisor, that's not a huge absolute sum of money that you're paying to the advisor. And honestly, the advisor has to probably charge that much, that percentage, just to make it worth his or her while to manage your money at that. $100,000 isn't chump change, but an advisor isn't getting filthy rich on that either. They have to, there's startup costs, there's everything that they have to pay for. So 1% at that level might make sense. It's drifting lower as things get more competitive, but when you get up closer to like $1 million or $1.5 million in assets that an advisor is managing for you, that 1% starts to get to be a pretty big number.
Yeah, that's $10,000. It's
$10,000 a year. This is exactly the reckoning I myself did, and you kind of go like, what am I getting for $10,000? And how is that different than when I was paying $5,000? And it isn't any different at all. So is that really a good way to go? I think, along with any conversation you'll have with a prospective financial advisor, or even the person you're working with now, is, what am I getting for this and why? And are there other things I'm not availing myself of for what I'm paying and that I should be? And then down to, maybe you negotiate your fee down. And that was the conversation I had with my advisor. I said, you're charging me 1%. This is too much for what I'm doing. You can either bring me down to like 80 basis points, 0.8%, or you can, I can go someplace else. When I went someplace else, I have much better service, very directly aimed at the things that I want and need. And I am paying probably on average, probably close to like 40 basis points. So half of what that would be when I asked.
That raises another interesting element to this. The fee, you're saying, Matt, is negotiable.
Fee is 100% negotiable. If advisors are really good, they're going to say, this is my fee. I'm not really going to move on it. Here's why. And now you're having a conversation about whether you're a good match for what they're doing, right? So, you could go into a French restaurant and say, I want to have a meal. It's $100. I don't want to pay $100. They're like, that's what we do. You get 3 courses. It's big. It's really, really good. Maybe you want to go to a diner or something that's better suited for what you're looking for this particular thing. That's probably a bad example, but you get the idea. There are times where the French restaurant is not going to say, okay, we'll take the salad off and it's $90. This is what we do, and this is what you're paying for, right? So I think most of that comes back to, having some idea, and this is free. You go out, you talk to 3 advisors, and you ask them about what they offer and why, and you educate yourself. It becomes it's something that could really save you a lot of money as you refine what you want out of your advisor, and then go and find an advisor who can provide it at a competitive rate.
We're talking with Matt Bartelli. He's the executive editor of the Dow Jones Wealth and Asset Management Group, and he's the leader of the team that produces the annual rankings of the top advisors in the country for Barron's Magazine. Let me invert the conversation here, Matt, and talk about the world of advising from the advisor's perspective, to give a little behind the scenes look for the sake of investors who are paying attention to this conversation. What are the issues that you are finding advisors are facing today? What are the advisors complaining to you about that they have to deal with that isn't something that clients would necessarily see on a daily basis?
So the biggest thing is sort of an aging white male workforce, particularly at the high end of this industry. If you sort the 6,000 or 8,000 people in a given year who give us 120 columns of data on their practices, and you sort them by gender and ethnicity, it is 59 to 62-year-old white males. And it's unbelievable to me every year how top heavy that is with that. Now, there's 2 things about that. First is, I still don't fully understand why that is. I mean, there's a million forces that get into the white male aspect of this, which that could be another podcast, Rick. But the age element of this is huge too, where most of the people who have done a really good job as financial advisors have kind of dragged the industry into the evolved state that it's in now. They've built their practices from just being people who used to cold call in the 1990s or 1980s to get clients, started out as commission-based people, have had their teams evolve into something that's much more holistic, that does a much better job of taking care of whole clients, isn't doing commission-based stuff anymore. But guess what? Along the way, they now have they've become not advisors, but people in charge of organizations, small organizations and teams, which maybe they didn't sign up for. Some are good at it, some are not so good at it. And now they're trying to figure out, how do I hand this off to another generation so this thing endures past me when I'm not 62, but I'm 68 and I start to sunset out of this thing? And that's a big question to answer. And people are not addressing it really, really well. They're struggling. A lot of people are struggling with it. It's not because they're stupid. It's not because they're bad at it. They're kind of pioneers at this. This is the first wave of advisors who have evolved and are kind of facing, how do I have this endure? It used to be advisors would be like, I'm done. Sell my practice. I get out. I get a check. Good luck, clients, with the new guy. Many more are trying to do a good job of making this thing that they've built, this team, endure beyond them, to carry on with the ethics and the ethos that they've built into their practice over the years, and to have that continue to serve clients into the future and multiple generations of clients. So that's a big enchilada I just described there, a big burrito full of stuff. But mainly it's like older, very accomplished advisors trying to figure out how to have this thing live on past them and take the best of what they've learned and inject it into their into this practice that will live past them, and to continue to serve clients of multiple generations. They're having a real tough time finding those people to come in and do these jobs in this industry. So it's an industry desperate for an injection of young talent, and specifically young women. We haven't even gotten into that, but it's this industry is 19% women, despite all of these efforts to kind of change that. It's just starting to change now. And these organizations that I described, RIA, independent firms, advisory firms, teams at the big firms, this is the mechanism that's starting to bring in more young women, more young people, and more young people of color into the industry that has not had it historically. And I think that is really going to change the face of the kinds of services that people on the receiving end receive, that clients receive, because they're going to see a wider range of people, which brings a whole new bunch of perspectives into the services and type of service they're going to receive.
And of course, as you know, you've articulated within that me. I mean, that's been my journey. I'm that 65-year-old white male who has been in this industry for 40 years and looking at my transition and trying to make sure that my departure from Edelman Financial would not be disruptive to the firm, to the staff, to the planners, to the clients, for providing that continuity that Gene and I had built over the decades in running that practice. And we engaged in a 6-year transitionary period to execute exactly that. To your exact point, that a lot of the advisors in my practice were older than me, in fact, and many have since retired. Recruiting younger, newer talent of women of color, and bringing in the diversity that this industry has failed to produce over the decades. So yeah, you're exactly right. We've gone through that exact same thing. And I find myself often, Matt, in conversation with other advisors around the country who turn to me asking, Rick, how'd you do it? And what did you experience? And because you're right, we're all pioneering this. This has never happened before because we're all first gen. There's never been an RIA before my generation. We invented this industry and we're the first going through all these elements. And so, yeah, it's a really important element. The way I would translate all of the above, Matt, to an actionable step for the client, for you, the investor, is to acknowledge that your advisor one day will leave. Perhaps involuntarily, they're hit by a bus. More likely, voluntarily, they choose to retire. You have to ask yourself, what happens to you when your advisor chooses or simply is not around anymore, whether it's they're on vacation for 2 weeks, in the hospital for 6 months, or in retirement or permanently? What happens to you, your account, your relationship, et cetera? Who do you turn to? If your advisor can't articulate an effective succession plan, that to me would be a red flag. And I'm assuming, Matt, that that's a question on your 120 column table of, tell us about your practice management.
It is indeed. And, so the numbers are not great, even among these really accomplished advisors. We ask, do you have a succession plan? And then we say, who is your successor? And if we worked really hard. You could ask 30 questions about this that would get to, but we try to ask like 2 that really cut to the heart of it. And do you have a succession plan? And then if you say you have a succession plan, but you can't say, Rick, Matt is your successor. And if I get hit by a bus, people know they turn to Matt to say, what are we doing now, boss? If that's not known to the people who are working on your team and to your clients, you don't have a succession plan. It needs to be both a disaster recovery plan in case something unexpected happens and the orderly transition that you were describing with you and Gene, which is over 6 years, there's going to be this gradual handoff. And the great thing about doing this job for this long period of time is I'm able to watch this happen in real time with a lot of the really good practices where you see over time, I'll be talking to, there's a great advisor in Morgan Stanley advisor in Washington, D.C. who I deal with. He's 78 years old now, still working. And he has been working with his number 2 over the years. And this has been like one of these things where he's here. And now it's like, he's sunsetting out. I don't think Marvin will ever go sunset off. But now his number 2 is the number 1 basically. And he's running things. That has happened. You didn't, you're boiling a frog kind of, you didn't even notice it. But now all of a sudden, AJ is this guy, right? That's the way it should work. You should give it enough time for that to work. But clients looking for advisors, when you're asking, if you're looking for 4 or 5 questions to ask, one of them should be, what's the succession plan? What does the team look like? Do you have staggered generations? If it's important to you, do you have people who look different? Who can come at things from a different perspective, who can people who are younger, people who are from a different race, people who are from, are not all men, who can come at this from different angles for you and inject a bunch of, critical thinking and stuff into the team that you wouldn't have otherwise if everybody's the same guy.
Now we've been assuming here, Matt, that everybody who's listening and watching this conversation has an advisor or is interested in finding a better or more suitable fit of an advisor. But the fact is that the minority of Americans have advisors. The majority do not have a financial advisor. What's preventing them from getting one?
Well, I think for starters, we're coming off of a 10 or 12 year period where, like, I'll just take my own kid who's coming home from college and will be upstairs soon. He had $1,100 left over from, first communion money and stuff, and he threw it into a robo betterment account, right? So robo investing, did a model portfolio, and that thing was earning like 26% a year just sitting there until recently. So I think there has been this sense over the last decade or so that you don't really need anybody helping you with investing, and that was probably true looking back. The place where an advisor comes in and can really help you. So what is it? It's about 40% of adults have financial advisors. Is that what you? I'm sure Financial Engines has a real good idea of that. Is that about right? What it is? About that. So 60% is unadvised, right? Or 60% of people in the States are unadvised. If you think you could do it, if all you care about is investing and you think you could do it yourself, you were a rock star for a period there. Again, I will put myself up as an example of this. The pandemic started, the bottom dropped out. I went to my advisor. I transitioned to my new advisor, and I was like, Maureen, what are we doing? Like, is the whole bottom going to completely drop out of this thing? And she was like, you're not touching anything. Like, leave it be. You should know better than anybody else. You work for freaking Barron's and you deal with financial advisors. Why are you even talking to me? Hang up the phone. So I did. And, if you look at what happened and what would have happened if I put all my money under a mattress there, it would have affected my retirement, like the way I would be able to retire. I'm 57 years old. So the answer to that is why would you want a financial advisor is for that. There are a few events or a few periods in time you could go over this thing and say, yeah, I could do this, I could do this, I could do this. Then you can't. And now you've created a situation where there isn't somebody awake at the switch and you lost 40% of your assets and you're not really going to figure out a way to get them back. Or you're going to do something stupid to try to get them back like you would at the racetrack. So that's the number one reason. And then the number two reason would be another kind of black swanish kind of event in your personal financial life, like, long-term care, things along those lines. Like one bad illness and you're not prepared for it can wipe out everything that you thought you were preparing for. Advisors could do a really good job. This is a great question to ask is, how can you help me of what black swan, what terrible events can you help me avoid that will let me keep going like this, rather than having something that I can't recover from at some point in my thing. That's where I think they bring the real value on the investing front. And then of course, if you have a lot of money, there are a lot of advisors who come in with a tax person and just say, I just saved you, an enormous amount of money going forward because I did some very basic things that you weren't doing. There's a whole range of things along those lines that you might think you're doing a great job on and you're not. And it's all a matter, I think, if you boil it down to somebody who's awake and at the switch all the time, rather than you who's doing all your other stuff and comes to it every once in a while and might miss something that would damage you in a real long-term way.
And our final question for you, Matt, regarding that very point, are there any topics or issues that are emerging that are not traditional within the field of advice that you find advisors, the very best advisors, are beginning to pay attention to that the vast majority of advisors are not yet? And more importantly, the vast majority of consumers and investors are not yet focusing. The thing that I'll plant one idea in your mind as you answer this, one that comes to my mind is the issue of longevity. So do you find that the very best advisors are forward thinking and talking about stuff with their clients that clients wouldn't otherwise consider?
At the wealthiest end, advisors who deal with the wealthiest people, you're not going to outlive your money if you have $50 million unless you're spending it wantonly, right? The big issue is if I'm not going to live till 81, I'm going to live till 111, which I know is this stuff is near and dear to your heart with the the singularity and all the advancements that are happening in medicine and technology, and there are these there's a lot of talk out there that your lifespan is really, really going to extend. So what does that mean when you retire at age 65 and now you have not 20 years or 17 years worth of living to do, but you have 40 years or 35 years? It's not a minor thing, right? So are the best advisors dealing with that? I would say the best advisors are grappling with that. I don't know that anybody has fully appreciated what you're going to do about that. What do you do if it's not 17 years and it doubles to 35 years, which it could, your life expectancy and the time you're going to have to make your retirement savings last? I think this is the single biggest issue facing people. And it's a little like the AI thing. Like, everybody knows this is something that could be a complete disaster and a time bomb, and it could come on really, really fast, but it's like so overwhelming you don't even know what to do about it. I think the place you start is to talk to your advisor about, what can you do to adjust the old school thinking of this is how we simulate how long you're going to live and all this, all the actuarial tables and stuff. What have you done to start to adapt to the fact that people live longer, and maybe I will? And what should I be thinking at the extreme end of how long I might survive versus what the average might say? And help adjust accordingly. You'll probably be doing your advisor a favor by asking that, to push them and nudge them into the direction of doing that. But it's a big open question, and it isn't something I don't think the industry has fully reckoned with yet.
So you need an advisor. You need to talk with your advisor about longevity. You need to talk to your advisor about the services they're providing, the fees that they're charging, how they can be of greatest value to you. And to get the help you need in finding an advisor who's right for you, turn to the Barron's rankings of the top advisors in the country. And that means you need to be subscribing to Barron's, which is mandatory reading for every advisor in this nation. Matt Barthel, executive editor at Dow Jones Wealth and Asset Management Group. Always a pleasure to be with you, my friend.
Rick, you too. Thank you so much for having me.
Meet Schwab Intelligent Income, a simple, modern way to pay yourself from your portfolio. Overcome the complexity of income needs in retirement with automated tax-smart withdrawals that you can start, stop, or adjust at any time without penalty. Plus ongoing monitoring, so you'll always know where you stand. And since lower fees means more money for you to invest, you pay no advisory fee. Available with Schwab Intelligent Portfolios. Visit schwab.com/intelligent income, a modern approach to wealth management.
Support for Rick Edelman's podcast comes from Invesco QQQ. What do all the greatest innovations have in common? Agents, people who participate in progress by supporting cutting-edge ideas. Invesco QQQ is a fund that allows you access to innovators of the NASDAQ 100 all-in-one fund, so you don't have to be an inventor to help create what's next to come. Anyone can become an agent of innovation with Invesco QQQ. Learn more at Invesco.com/QQQ. There are risks when investing in ETFs, including possible loss of money. ETFs' risks are similar to those of stocks. Investments in the tech sector are subject to greater risk and more volatility than more diversified investments. The NASDAQ 100 Index comprises the 100 largest non-financial companies on the NASDAQ. You can't invest directly into an index. Before investing, carefully read and consider fund investment objectives, risks, charges, expenses, and more in prospectus at Invesco.com. Invesco Distributors, Inc.
This is The Truth About Your Future. I'm Rick Edelman. Last week, I told you about Bitcoin mining. Miners are the people who do those complex computer calculations to validate the data that's on the Bitcoin blockchain. If you're confused about what I just said, just go listen to last week's show where I explained all this. The link's in the show notes. But how much Bitcoin do Bitcoin miners get when they engage in mining? Well, back in 2009, miners were rewarded with 50 Bitcoins every time they solved one of those puzzles every 10 minutes. Well, they don't get 50 Bitcoins anymore. Every 4 years, the reward for mining gets cut in half. It's called the halving, or halvening. Take your choice as to which word you prefer, halving or halvening. Anyway, in 2012, the reward was cut from 50 bitcoins to 25. In 2016, it was cut again to 12.5. And in 2020, it was cut once more to 6.25. That's the reward that Bitcoin miners get today when they solve those complex calculations, 6.25 bitcoins. And the reward is going to get cut again in 2024, just 6 or 8 months from now, to 3.125. The fact that these mining rewards get cut roughly every 4 years, they get cut in half, this is a basic reason why so many people say that the price of Bitcoin keeps doubling. I mean, think about it. If a miner gets only half as many Bitcoin as before, then they want each Bitcoin to be worth twice as much. So with another halving coming in 2024, will the price of Bitcoin double again? It's doubled every time so far there's been a halving. We're going to, of course, have to wait and see what happens this time around. Personally, I do expect a doubling or more to occur, but there's no guarantee. I encourage you to learn more about all of this. You can do so by reading my #1 Amazon bestseller, The Truth About Crypto. Hey, if you've got a little downtime this summer, who doesn't, you can catch up on past episodes of this podcast at thetafe.com. You know we cover the 5 personal finance topics that matter most: longevity, retirement security, exponential technologies, digital assets, and health and wellness. It's thetafe.com. The link is in the show notes. See you Monday.
The Truth About Your Future with Rick Edelman has been brought to you by Global X ETFs, dedicated to providing investors with unexplored intelligent solutions, and by Invesco QQQ. Anyone can become an agent of innovation with Invesco QQQ, Invesco Distributors, Inc., and by Presidio, offering a digital vault where you can collect, protect, and share all your important people, places, things, and documents with all the key people in your life. Start for free at Presidio.com.
Get the truth about your future with Rick Edelman. It's thetruthayf.com.